Silver just broke a promise it made to every trader watching $60 turn into reality. And then, without warning, it vanished. Billions in positions, wiped out in hours. But here is what nobody is telling you. This was never just a market correction. This is a war fought on two fronts at once. On one side, a central bank quietly preparing a strike that could crush metals for months. On the other, oil, tankers, and a Middle East conflict spiraling towards something far bigger than headlines suggest. And caught in the middle, silver, bleeding from both directions, but underground, beneath the panic, beneath the charts. Something else is happening. Mines are running dry. Nations are hoarding what little silver remains. The question is no longer if silver moves, it is which direction breaks first, $50 or 70. Stay with us, because by the end of this video, you will understand why the next 30 days could decide everything. Welcome, my friends, to Stick Zennn. Now, before we go any further into this story, I want to ask you something the way I would ask my own father or my own grandfather if he were sitting right here with me. If you find value in what we share here, would you do an old man's heart some good and press that subscribe button? It costs you nothing, but it means everything to a small channel like ours, trying to bring you the truth the big networks won't. And tell me, in the comments below, where in the world are you watching from today? I read every single one, and I would love to know who is sitting with me for this story. Now, let us begin. For weeks, traders watched silver climb, higher and higher, toward a wall everyone was waiting to see broken. $60 an ounce. It felt close. It felt certain. Analysts were already talking about what came next. 70, maybe higher. Then, in a single trading session, everything changed. Silver touched just above $61, and then it fell. Hard. Within days, it dropped back into the $57 range. The short-term uptrend that traders had trusted for weeks broke apart. Stop-loss orders triggered across the market, one after another, like dominoes falling in a dark room. Many people online called it a simple pullback, a normal correction after a fast run-up. But those who study markets closely knew something deeper was happening. Silver was not just correcting. It was caught in a war fought on two fronts at once. And the first front was interest rates. Here is something every serious investor must understand. Silver and gold do not pay interest. They do not pay a dividend. When someone holds physical silver, they are not earning anything extra just by holding it. But government bonds do pay something. And when interest rates rise, those bonds become more attractive. Suddenly, holding silver comes with a cost of missing out on safer, guaranteed returns elsewhere. This is called opportunity cost. And right now, that cost is rising fast. Recently, the yield on the 10-year United States Treasury bond jumped to its highest level in over a year. This was not a small move, it was a signal that the market believed the Federal Reserve was about to become more aggressive, not less. Just weeks earlier, traders believed there was only a moderate chance of another interest rate hike. Now, that probability has jumped dramatically. The market flipped its expectations almost overnight, and it was not only happening in the United States. Across the Atlantic, the European Central Bank held its key interest rate steady. But the message from its leadership was clear. Rising tensions in the Middle East, along with sudden shocks in energy prices, were creating serious risks of higher inflation. The European Central Bank refused to rule out its own rate hike in the months ahead. When two of the world's most powerful central banks signal higher rates for longer, non-yielding assets like silver and gold feel it immediately. Gold dropped sharply in recent trading sessions. Silver, too, came under heavy pressure. This is the first front of the war, a quiet mathematical battle, fought not with weapons, but with interest rate decisions made in boardrooms thousands of miles away from any mine or vault. But something strange is happening. This war does not follow simple rules. It is not one-sided. Because while rising rates push silver down, there is another force pulling from the opposite direction. A force born not from economics, but from conflict, oil, and fear. That force is building on the other side of the world, and it is about to collide directly with everything the rate market is trying to do. The two forces cannot both win. One side must break. And when it does, it will decide whether silver crashes toward $50 or begins a climb that could carry it past 70. What happens next depends on a battlefield far from Wall Street. One built on oil tankers, warnings of military action, and a region already on edge. That battlefield is where the real story begins. While interest rates were quietly squeezing silver from one side, a second, louder battle was unfolding thousands of miles away. And this one was not being fought with numbers on a screen. It was being fought with tankers, warnings, and the threat of real military action. In the Red Sea, tensions flared once again. Reports emerged of attacks targeting major oil tankers, and the response in energy markets was immediate. Crude oil prices surged past $100 a barrel for the first time in months. This was not a minor fluctuation. It was a shockwave that rippled through every corner of the global economy. The United States responded with strong language, warning of possible direct military action against those responsible. Regional powers began weighing their own involvement. The situation, already fragile, grew more unstable by the day. Under normal circumstances, this is exactly the kind of moment that should send investors running towards silver and gold. These metals have always been seen as safe havens, assets people turn to when the world feels uncertain, when governments seem unstable, when war feels closer than peace. But this time, something unusual happened. Instead of rising, silver came under even more pressure. To understand why, one must think like a central banker, not like a trader. When oil prices spike because of conflict, central bankers do not simply see a geopolitical crisis. They see something else entirely. They see inflation, a fresh wave of it, arriving fast and hard. Oil is not just fuel for cars. It is woven into the cost of nearly everything. Shipping, manufacturing, food production, electricity. When oil prices rise sharply, those costs move through the entire economy, pushing prices higher across the board. For a central bank already worried about inflation, a sudden oil shock is not a reason to relax. It is a reason to become more aggressive. It becomes another argument for keeping interest rates high, or even raising them further to keep inflation from spiraling out of control. This creates a strange and painful irony for silver. The very conflict that should be pushing investors towards silver as a safe haven is instead giving central banks more reason to raise rates. And higher rates, as explained earlier, make holding silver more expensive and less attractive. In other words, the war in the Middle East is not helping silver. It is quietly strengthening the hand of the very forces working against it. This is the paradox sitting at the heart of the current market. Two forces that should logically pull in opposite directions, one from fear, one from monetary policy, are instead pointing in the same direction. Both are pressuring silver downward, at least for now. For the everyday investor, this can feel confusing. Shouldn't war and instability always be good for precious metals? The honest answer is that history says yes, eventually. But markets do not always move in straight lines, and short-term reactions can look very different from long-term outcomes. In the short term, oil-driven inflation fears are winning. Silver is being squeezed, not lifted, by global instability. But this raises an important question. If both major forces, interest rates and geopolitical conflict, are working against silver right now, why are serious analysts still not abandoning their long-term bullish outlook? The answer lies beneath the surface, literally. Because while paper markets and headlines are focused on rate decisions and oil tankers, something very different is happening in mines, warehouses, and ports around the world. A quiet imbalance is building, one that has nothing to do with interest rates or war, and everything to do with simple supply and demand. That imbalance may end up mattering more than anything happening in the headlines today. And it is exactly where the story turns next. While the world's attention stayed fixed on interest rates and oil tankers, a quieter story was unfolding, one most headlines were completely missing. Beneath the noise of central bank decisions and geopolitical threats, the physical silver market was sending a very different signal, and that signal had nothing to do with fear or speculation. It had to do with something far simpler: how much silver actually exists and how much people actually need. Consider what was happening among the world's largest silver producers. One of the biggest names in primary silver mining reported a sharp drop in production, down more than 12% compared to the year before. For the first half of the year, output had fallen by over 11%. The reason was not a lack of effort or investment, it was something harder to fix quickly. The ore being mined was simply becoming less rich in silver. Mines were producing less metal for the same amount of work. This is not a small detail. When a major producer sees production decline this sharply, it removes real physical supply from a market that was already tight. At the same time, on the other side of the world, a different kind of pressure was building. In one of the largest silver-consuming nations on Earth, new government regulations around importing silver created chaos in supply chains. Import volumes slowed dramatically, but demand did not slow with them. Instead, local premiums, the extra amount buyers were willing to pay above the global price, surged to their highest levels in months. People wanted silver. They simply could not get enough of it through normal channels. Now place these two facts side by side. A major producer mining significantly less silver. A major buyer struggling to import enough silver to meet demand. Under normal market conditions, this combination should be explosive. Falling supply combined with rising physical demand is the textbook recipe for sharply higher prices. It is basic economics, the kind taught in any introductory business class. And yet, silver's price was not reflecting this reality at all. Why? Because right now, two very different markets are operating almost independently of each other. There's the physical market, where real metal changes hands between miners, refiners, and buyers. And there is the paper market, where silver is traded through contracts, futures, and speculative positions that often have little connection to actual physical metal. At this moment, the paper market, driven heavily by interest rate expectations and short-term fear, is overwhelming the physical market's quieter, more fundamental signals. Traders reacting to central bank announcements are moving prices in ways that ignore what is actually happening in mines and warehouses. But experienced market watchers know something important. This disconnect rarely lasts forever. There were even signs that major shifts in how silver is traded, particularly changes affecting large paper trading systems in Asia, could soon reduce the influence of speculative positioning. If that happens, the physical market's true tightness may finally have room to show itself in the price. This is the paradox investors must understand. On the surface, silver looks weak, pressured by rates and inflation fears. Beneath the surface, the actual physical foundation of the market is quietly tightening, mine by mine, shipment by shipment. History has shown, time and again, that physical fundamentals eventually reassert themselves. Paper markets can distort prices for weeks or even months, but they cannot indefinitely ignore a genuine supply shortage forever. For the young entrepreneur or serious investor watching this unfold, the lesson is clear. Headlines move fast, but they do not always tell the full story. The real story, the one that matters most for the future, is often found quietly beneath the noise and production reports and import data most people never bother to read. And this quiet imbalance may soon collide with something else entirely. The technical price levels every trader is watching right now, and the long-term forecast that suggests this entire battle may end very differently than the current panic suggests. That is where the story goes next. For every trader watching silver right now, the daily chart has become a battlefield map. Every level matters. Every close, whether higher or lower, tells a story about who is winning this two-front war. On the downside, the most important number was $60. For weeks, this level acted like a wall, a psychological barrier that silver had struggled to break through. When silver finally pushed above it, briefly touching just above $61, it looked like victory. But the rejection that followed was swift and severe. To regain that bullish momentum, silver would need to reclaim that $61 level convincingly, then push further towards $63 and $64. Above that sits an even bigger obstacle, the 50-day moving average, sitting near $66. This line represents the average trading price over the past 50 days, and as long as silver remains below it, the short-term trend stays tilted toward the sellers, not the buyers. It is a ceiling that must be broken before anyone can seriously talk about a return to the highs. But the real battle line, the one separating a healthy pullback from a deeper breakdown, sits lower. $55 has become the critical support zone. This is the level that bulls must defend at all costs. Just below it sits another marker, the low reached in mid-July, sitting just under $55 as well. If $55 fails to hold on a closing basis, the path downward becomes much clearer. Analysts see a real possibility of silver falling toward $50, and in a worse scenario, potentially revisiting lows not seen since late last year, near $48. These numbers might seem small to someone outside the market, but for traders and long-term stackers alike, each dollar represents a decision point, a place to buy, a place to protect capital, a place to wait. Now, step back from the daily charts and look at the bigger picture. Even after a pullback of roughly 50% from its all-time high reached earlier this year, serious long-term analysts have not given up on silver's future. In fact, many see this sharp correction as something healthy, not something alarming. One leading voice in commodities research made an important point. This heavy pullback flushed out speculative excess without solving silver's deeper structural supply problem. In simple terms, the people who were buying purely out of hype and excitement have already sold. What remains is a market driven by real underlying scarcity, not emotional trading. This distinction matters enormously. Markets driven by hype can collapse quickly and stay low for a long time. Markets driven by genuine shortage tend to find a floor, then eventually rise again once the panic fades. So where is future demand expected to come from? Not from where most people assume. 3 major global trends are quietly reshaping long-term demand for silver. The modernization and expansion of electrical grids around the world, the rapid build-out of artificial intelligence infrastructure and advanced hardware, and the construction of next-generation data centers to support all of this new technology. Interestingly, solar panel demand, once considered silver's biggest growth story, now plays a smaller role compared to these newer industrial forces. Because of these long-term industrial tailwinds, some major research firms are forecasting silver prices returning towards $70 an ounce by the middle of 2027. It is also worth noting that silver's volatility, its tendency for large price swings, sits at nearly double that of gold. If gold behaves like a steady, slow-moving ship, silver behaves like a much faster, more unpredictable vessel, capable of sudden and dramatic moves in either direction. This brings the story to where it truly matters. What should someone watching all of this actually do? For short-term traders, the message is simple. Watch the $55 support level closely. Watch the $60 resistance zone just as closely. These numbers will likely determine the next major move whether that move is downward toward crisis levels or upward toward renewed confidence. For long-term investors, particularly those thinking years ahead rather than days, these macro-driven pullbacks may represent exactly the kind of entry point patient investors wait years to find. History has shown that structural supply deficits, once ignored by panicked markets, tend to reassert themselves eventually. Silver remains caught between two powerful forces: a hawkish, rate-driven macro environment pushing prices down, and a tightening physical market building pressure beneath the surface. Both cannot remain in control forever. One side must eventually break. Whether that break sends silver crashing toward $50 or launches it on a path toward 70 may depend less on headlines and more on the quiet, structural realities unfolding far from the daily noise of trading screens.